There are many ways in which you can fund your property deals. So in this video, we're going to do a deep dive on mortgages, bridging finance, and development funding so you can start, scale, and grow a high cash flowing property business that takes you from where you are now to where you need to go. Hey, my name's Liam Ryan and welcome to this channel. If you are new, smash the subscribe button, hit the notification bell. If you can hit the like button, I would really appreciate that because it helps the algorithm. I love business, I love property. So let's have a look now at mortgages, bridging finance, and development funding. So let's have a look at what a mortgage is. A mortgage is a legal agreement by which a bank building society lends money at interest in exchange for taking title of the debtor's property. You can go and get a fixed rate or adjustable rate mortgage. You can use a broker to shop around for the best deals. I do not recommend that you start walking into all your high street banks. High street banks can be really good for residential mortgages, but when it comes to investment mortgages, you'll typically find they don't have the best options, they don't have the best rates or deals available, and they're very limited on the products they offer. So you're always better using a broker that specializes in rental investment type mortgages, HMO type mortgages, commercial type mortgages, and you get different types of brokers. Like we've got some brokers that purely focus on finding us companies that will lend us money for development funding. Then we've got a broker which is really good for single let type products, and we use David Tonks a lot for our HMOs and other commercial type lender. And typically the bank will lend you 75% loan to value, and you have to go and find 25% as the initial down payment. Now, Kent Reliance have got an amazing product, 85% loan to value on their HMO product, so you only have to find 15% as your down payment. And if you don't have that money, you can always do a 50-50 JV with an investor where they put in the money and you do the work. So there's lots of options out there. It's always best to see what's available in the marketplace, and you then decide if you want to go fixed. So let's have a look at fixed versus adjustable. With a fixed rate mortgage, it means that the rates and payments are lower, a higher percentage of money being approved can happen. There's no need to refinance to take advantage of lower rates. After the introductory term ends, rates can increase steeply, so you need to keep an eye on that. So let's have a look at adjustable rate mortgages. Okay, so you've got fixed and you've got adjustable. Adjustable rate mortgages, rates and payments are lower, a higher percentage of borrowing being approved so you can potentially get more money. There's no need to refinance and take advantage of lower interest rates, but be very careful that you might get like an introductory term of say 2 years, this really low interest rate, but after 2 years it will increase really fast and you're gonna need to switch into a new deal. And it can be a little bit more complicated. So a few things for you to be aware of. I would always be taking advice from my broker, and I'd always be looking at the market at the time of getting the mortgage, okay? I'm not saying that we are definitely correct getting more fixed rate mortgages. Some people prefer to have adjustable rate mortgages. But for us as property investors, we just like to know where we stand every month with our HMOs, because that's, we do a lot of HMOs. Then you have what's called interest-only mortgages or repayment mortgages. So let's have a look at the difference again, because it's something for you to think about. So let's have a look at interest-only mortgages. You only pay the interest to the lender each month. So you're not paying down the capital, it's only the interest that you're paying. At the end of the term, you're still gonna owe the initial amount borrowed, your monthly payment is always lower with an interest-only mortgage. Typically, you'll get investment interest-only mortgages for 10 years, but inflation can erode the debt. And this is what I love about interest-only mortgages. There is a good chance, because history tells us that since 1088, property prices have doubled pretty much every 10 years. Hey, not in every part of the UK, but lots of different areas in the UK. So if property prices double in the next 10 years and then you refinance, that's going to pay off a lot of the initial mortgage interest that you borrowed at the beginning. So what we're hoping, but it's not a guarantee, is that inflation as well will erode that debt, because hey, £100,000 in 10 years or 20 years is going to be a lot less than what it is today. Now, let's have a look at capital repayment mortgages. You gradually repay back the money borrowed over the term of the loan, which is typically 25 years. You're guaranteed to pay the loan back by the end of the term, and the mortgage payment is a lot higher because you're paying off interest and you're paying off the capital. Now, for me as a property investor, I'm quite aggressive with my approach. I'm 39 years of age as it stands. Bloody hell. I feel like I'm in my 20s, to be honest with you. And for us, we purely want to focus on high cash flowing strategies. We want the portfolio to generate as much cash as we possibly can so we can use that cash to reinvest. And what we are hoping is that over the next 10 or 20 years, that through property prices increasing, through inflation, that the value of that property at some point in the future will help pay off the initial mortgage. Obviously, there's no guarantees with that. Now, as you get slightly more mature, hey, maybe you're in your 50s or you're in your 60s, then you might want a slightly different approach where you're actually paying down some of the mortgage, or you're not as highly leveraged. So at the moment, we're probably leveraged at 80% across the portfolio. Some of our deals are 75% loan to value, some are 85% loan to value. Maybe another 10 years from now, I'm going to want to start being not as highly leveraged, and I might only want to be leveraged at say 50 or 60% loan to value, which means I've got a lot more equity in the portfolio. It really is a personal preference. And again, my top advice to you is get a very, very good broker on side. Get the broker to do the hard work for you, assess every property deal at the time, and then make a decision based on the evidence that is given to you. Bridging finance is a short-term loan getting you from A to B till you secure a more permanent option. Now, a bridging loan is more expensive, and you may be paying in the region of 1% per month. So that's 12% a year. Plus you've got some in and out fees. So you could be looking at maybe 14, 15, 16% interest over a 12-month period. I've had bridging finance before. I got some bridging finance to do some of my refurb projects in Crewe and Stoke, and I ended up paying about 14.5%, 15% over the 12 months. But bridging can be arranged in a short time. I'll do that again. Bridging can be arranged in a short time period. You'll typically get a bridge loan between 3 and 24 months, and it's really good for refurbishments, auctions, and financing some of your developments. And the bridging company is going to have what's called first, second, or third charge on that property. So I'll give you an example. I bought some HMOs in Crewe and Stoke. The mortgage company had what's called first charge. So if I ever defaulted, never paid the mortgage, and they needed to come and claim that property, then they are the first people in line to get paid out when the asset is sold. A bridging company ideally would like first charge, but in a lot of cases, you'll already have a charge on an asset where you're looking to raise some additional funding. So the bridging company might get second or third charge, which means they're slightly down the pecking order, which means their risk increases, and this is why they typically charge more money as an interest. The other reason they charge slightly more is that they know that they can get money out to you very quickly. I know with David Tonks at Advocate Finance, he's had a couple of occasions where someone has applied for a bridge and they've managed to get the funds within literally just a few days, You're gonna wanna pay your bridge off as quickly as possible with a cheaper solution, right? Shawbrook, they do a really nice bridging product where they will actually help you purchase the entire product on a bridge. They'll give you that for a period of time, say 3 months, allow you to do the refurb, and then they'll switch you into one of their mortgage products. We actually did that with one of our JV deals in Ipswich, with one of our joint venture partners. We got a bridging type product from Shawbrook Bank and then switched into their commercial products, and that worked really well for us. It was a really good solution. So keep an open mind with bridging. It's also really good for auction properties, because a lot of the time when you go to auction and you want to buy something run down, the dirtiest, smelliest, ugliest house on the street, it's normally not livable. And unless a property is livable, i.e. a kitchen, running water, toilet, shower facilities, you can't actually get a mortgage. So a lot of people, they use auction bridging finance to take you from point A to point B. You get the bridging finance, short-term loan, you purchase the property at an auction, you get in there, you do a quick turnaround on the refurb, and then you switch into a normal mortgage product. So again, keep an open mind on bridging. It can work really well, but also be aware that if you don't pay it back in the time frame, there can be some real big penalties. So development funding is a loan facility that goes towards the purchase of a land or development deal. There's a range of funding companies and options available. I would recommend that you use a commercial funding broker that has got access to all of the commercial lenders. And typically speaking, the commercial funder will lend 50% of the land purchase and 70% of the development costs. You then may need to find in the region of 20 to 30% as your equity piece, and the development funder will have first charge. Let me just show you a quick example, all right? So let's say you find a piece of land and it's £100,000 to purchase. Let's say the construction costs are £500,000. Well, the development funder may give you £50,000 towards the purchase price, £350,000 towards the development cost. So that's £400,000 they'll give you, which means you will need to find £200,000 as the equity piece to show the development funders that you have got skin in the game. Now, where can you get that money from? You're going to get it from your own bank account, or you're going to go and joint venture with investors. And later in this module, I'm going to be showing you exactly how to raise these funds. And wherever possible, I always look to use investor money. Now, this is pretty much worst case scenario, okay? Whenever Jay calls me, and I love getting these phone calls from Jay, and when you start getting these calls, it's really exciting. Jay will call me, right? And he'll say, Liam, I've had an amazing day. I've just found us another deal. We've just had the offer accepted. What I will say to Jay is I'll say, Jay, that's really good. What is the total cost? what's the total cost? And he might say to me, look, the total cost, purchase price, plus the refurb or the new build cost and all the legal fees, let's say we're in for £1 million. In my head, I think, right, how much do we need from investors? I'll work out 20% of total cost. So in that example, I will just think, right, we need to find £200,000 from investors. Now, in some cases, we might need to find a bit more. We might need to find a little bit less, but I'm going to be there or thereabouts when it comes to our development sites. And we use a company called LendInvest. LendInvest is just one of our development funders where you can go and raise money. They're development funders. They've got access to thousands of investors. They can raise money for your developments fast. They are currently looking for new deals. There's a simple application process, about 4 to 5 weeks for approval. You find the deal, they find the money. You basically can scale up quick once the trust has been built. So it's more of a personal service. You won't necessarily get the best rates in town, but you can potentially get the money quick. And if you're a newer type developer, then they're more open to work with you. If you go to someone like Lloyds Commercial, yeah, you'll get a much better rate, but the whole process might take 12, 16 weeks. And if you're a new developer, they might not take that too kindly and they might just sort of like kick you out of the door. So again, like mortgages, like bridging funding, when it comes to development funding, there's lots of development funding options available. You've got to go and hunt the marketplace using a commercial broker and see what is the best deal that you can get, and ultimately keep an open mind about bringing in a more experienced developer that can join up with you so you can get that funding easier and you can get it at a better rate. Development funding, I absolutely love. You know, one of our latest developments, we've got about £4.5 million from the development funders at about 7%. That is cheap money. And by doing this, you're really able to scale, and you can also do multiple developments at any one time. I've now been in the property space for over 20 years. And look, here's the thing. If I can do it, you can definitely do it. It's about getting the right education, having a great mentor, hanging out with a great team. Property right now in the UK is booming. There are just so many opportunities, and you can literally get started using none of your own money, creative financial techniques. So stay tuned for more of my videos. See the free resources in the comments below, and I look forward to hanging out with you very, very soon.